Standard disclosure up top. I hold a personal long position in Blue Owl Capital, ticker OBDC, at the time of recording. The position size and timing are not disclosed, and the position can change without notice. The methodology you're about to see produces lens reads independently of any position that I hold. Now the analysis. We use 4 AI systems to read different parts of a public company's filings and external data, then preserve their disagreement on the record instead of averaging it into a single recommendation. Here's what they read on Blue Owl Capital and what the May dividend cut just told us about each lens's evidence. Blue Owl Capital just cut its Q2 dividend 16% after Q1 net investment income came in below the prior distribution. The same net investment income coverage gap that drove the cut is what our Forensic Jury Auditor read as the primary risk vector. 3 lenses converged on a coverage risk. 1 pulled stale data and produced a now falsified bullish read. All 4 are on the record. Here's what each one saw. The forensic jury is a 4-lens methodology built to read individual public companies through 4 independent reasoning passes. Each lens reads a different evidence layer. Each returns its own verdict and a confidence level. The methodology preserves the disagreement on record rather than averaging it into a single recommendation. Today, we walk through what each lens read on OBDC. The dossier output was hold at medium confidence. The 3 lenses converged on hold. 1 lens, the Sentinel, which reads external data, and the macro cycle produced a buy at high confidence read in its first pass. It predicted on what it called an imminent earnings catalyst. The earnings the event Sentinel called imminent had actually happened 8 days prior to the methodology run. The post-event actuals invalidated the bullish thesis. We preserve both Sentinel reads on the record, the original buy based on stale external data and the corrected hold that reflects the May 7th reality. That's the methodology's transparency, promise, and practice, not infallibility. Let me start with what just happened, because the dividend cut is the news anchor for everything that follows. On May 7, 2026, Blue Owl Capital reported Q1 2026 results on the conference call following the May 6 release. The print was a miss on both lines. Adjusted net investment income came in at 31 cents per share against a consensus of 35 cents. Revenue was $396,770,000 against a consensus of $426,490,000, a roughly 7% revenue miss. Alongside the print, management announced a 16% reduction to the Q2 2026 base dividend. The quarterly base dividend drops from 37 cents per share to 31 cents per share. That number, 31 cents, is the same as the Q1 net investment income per share. The dividend is being right-sized to what the underlying earnings can actually support. Now turn to what the methodology was reading and what the auditor lens flagged the primary risk vector when the workflow ran. The auditor reads the books, the 10Q, the 10K, the cash flow statement, the segment disclosures, the balance sheet. For a business development company like OBDC, the load-bearing metrics are different from a SaaS company or a hyperscaler. The auditor reads net investment income per share, the dividend coverage ratio that compares NII to the distribution, and the net asset value per share trajectory, debt to equity, and non-accrual rate. Here's what the auditor read on the trailing 12 months data prior to the reporting period. Net investment income per share, trailing 12 months, $1.24. Quarterly dividend at the time of analysis was 37 cents per share, annualized to $1.48. Net investment income coverage, 124 divided by 148, which is 0.82 times. The dividend was being paid at a rate higher than the underlying net investment income could support. That gap is what the auditor flagged. Read from the dossier. The dividend is not covered by net investment income. The shortfall is roughly 27 cents per share annually. For a BDC, this is the load-bearing finding. BDCs are required by a regulated investment company rules to distribute substantially all of their taxable income. When a coverage ratio drops below 1, either net investment income has to recover or the distribution has to come down. Otherwise, the gap is being funded by other sources, portfolio markups, return of capital, or share issuance-driven net asset valuation dilution. The auditor's verdict on OBDC was hold at medium confidence. The hold reflects the unresolved coverage gap. The medium reflects offsetting evidence. Net asset value had grown from $11.62 in 2022 to $14.62 in 2025. The price to NAV ratio was around 0.79 times, meaning the stock was trading at 21% discount to net asset value. Dividend yield was 13.4% at the pre-cut rate. The discount and yield could be rational compensation for the coverage risk, or could be market mispricing. The auditor doesn't take a position on which. It flags the coverage gap and lets the price evidence speak separately. The auditor also noted a subflag on the net asset value trajectory. 2022 to 2024 series ran 1162, 1190, and 1176, roughly flat. Then 2025 jumped to 1462. That two-step change is most plausibly explained by the OBDC and OBDC2 merger that completed January 2024 with a portfolio markups and accretion accounting, mechanically inflating the reported net asset value per share. The auditor flagged the 2022 through 2024 series, and the 2025 mark shouldn't be read as continuous organic growth. The architect lens reads management's language. The architect doesn't recompute the numbers. It reads how management talks about them. In OBDC's management commentary preceding the Q1 print, the language carried forward looking optimistic about underwriting standards, sector spread environment, and portfolio quality. What the language did not do was bridge the gap between the coverage ratio sitting in the financial filings, 0.82 times, and the dividend policy that was being maintained at a higher rate. The architect's verbatim read, the language carries forward-looking optimism without bridging the coverage gap that the underlying numbers reveal. That's not a claim that management was concealing anything. The coverage ratio is in the public filings. Anyone with the filings can compute it. The architect is reading a different layer, the rhetorical posture. When management's language doesn't explicitly address the metric the filings flag as the primary risk vector, that's a gap the architect catches. The architect's verdict on OBDC is a hold at medium confidence, same as the auditor. Different evidence layer, same conclusion. The storyteller lens reads what management leaves out. The omissions tell you something the prose does not. For OBDC, the storyteller flagged a specific structural omission, the non-accrual rate. For a business development company, the non-accrual rate is the paramount indicator of underlying portfolio health. It tells you what percentage of the credit portfolio is currently not paying. The loans where the borrower has stopped paying servicing the debt, and for a BDC, a deteriorating non-accrual rate is the leading indicator that distributable income is going to come down. In the data and the methodology read, the non-accrual rate field was returned as N/A, not a zero, not a low number, not high, just unparsable. The storyteller's verbatim read for a BDC non-accrual rate is the paramount indicator of a portfolio health. The N/A here is a silent removal of a critical risk indicator. This is not the same as accusing management of hiding the figure. The data feed return N/A. The underlying SEC filings may or may not have disclosed the actual number elsewhere. But the methodology had to flag the critical path metric that was not parsable at the point the analysis ran. When the load-bearing indicator goes unparsable for a credit investing vehicle, that's a forensic flag in its own right. The Storyteller's verdict on OBDC is a hold at medium confidence. The data gap flag is real. The hold reflects that you can't responsibly read a BDC without that metric resolved. The Sentinel lens read the macro cycle, external data, and the news flow. The Sentinel queries third-party sources through a web search pass, analyst consensus, recent news, post-earnings tape, dividend trajectory across the sector. On May 14, 2026, when the methodology ran and executed, the Sentinel produced a verdict that diverged from the other three lenses. It returned a buy at high confidence. The Sentinel's verbatim original read, pre-earning stability on a 0.8 times net asset value with 13% yield screams undervaluation at a high yield BDC sector. There was a problem with that read. The Sentinel was referencing what it called imminent Q1 2026 earnings on May 6, 2026, a print it expected to be a positive catalyst. The earnings event had actually happened 8 days earlier. The external sources the Sentinel queried via web search had not yet surfaced the post-May 7th actuals at the point the queries were made. The bullish thesis was predicated on stale external data. That's exactly the kind of error the methodology's external citation verification discipline is built to surface. We caught the Sentinel's stale data in a verification pass. We have two choices when this happens. We can drop the read, scrub it from the record, and pretend it didn't happen, or we can preserve it for transparency and disclose what went wrong. The methodology promise is to preserve disagreement on the record. We preserve the Sentinel's original buy with the explicit disclosure that it was sourced from external data that did not reflect the May 7th actuals. And we rerun the Sentinel pass with the corrected post-print data. The corrected Sentinel read is now a hold at high confidence. Both reads are on the canonical dossier. That is what the methodology honestly looks like in practice. Not infallibility, transparency about what each lens read, what each lens missed, and how we caught the data freshness failure. Step back from the lens by lens reads. Here's the structural picture. 3 lenses converged on hold at a medium confidence. The reasoning across all 3 was anchored on the same findings: net interest income coverage at a 0.82 times, the merger distorted net asset value series, and the missing non-accrual rate. The gap between management's forward-looking language and the underlying filings. The 4th lens, the Sentinel, originally diverged with a buy at high confidence based on stale data bullish thesis. The post-print correction brought the Sentinel back in line at a hold at high confidence. Both Sentinel reads are on the public record in the canonical dossier. Then on May 7th, Blue Owl Capital reported Q1 2026 net investment income at 31 cents per share, below the prior 37-cent distribution that the coverage app had flagged as unsustainable. Management cut the dividend 16%, bringing the Q2 base rate to 31 cents per share. The cut right-sized the distribution to what the underlying earnings can support. The dossier output and the dividend cut both center on the same metric: net interest income coverage. The methodology read it as a primary risk factor. Management responded by lowering the distribution to a level the underlying net investment income can support. This is the methodology's job: not to predict the future, to read the load-bearing metrics in the filings, preserve the disagreement between lens-level evidence layers, and surface the data freshness errors transparently. Put it all on the public record. So the final dossier's output. Hold at medium confidence. Jury split 3 lenses on hold, 1 lens at buy in the original Sentinel read with an explicit stale data disclosure. Then hold at high confidence after Sentinel correction. The forensic tension is on the record. The underlying coverage gap is real. The post-cut yield is still in the high single to low double digits depending on the price the day you check. The net asset value discount is partially explained by the merger disordered series and partially by the market pricing the coverage risk. The dossier does not resolve which. What the dossier does not say is what any individual investor should do with the stock. It says, here are the lenses, here's the evidence, each one read. Here is where they converged, and here is where they diverged. The methodology's job is to put the disagreement on public record with citations and primary sources, so the reader can do their own work from there. If you want to know which BDC or real estate investment trust or income sector names we run through the forensic jury in the upcoming Be the Exception cycles, the editorial calendar lives in the audience. Reply in the comments or to the newsletter with the names you want us to dig into. We don't promise per request output. The editorial calendar gets shaped by the reader input that surfaces over time. The full OBDC dossier with every lens read, every primary source citation, every chart in the Sentinel stale data disclosure is at the Insightful Agents website. The link is in the description. The next dossier ships next week. So the index disclosure, I do hold personal long position in OBDC at the time of recording. Position size and timing is not disclosed. The position can change without notice. The methodology produces forensic analytical output independently of any personal holdings. This is forensic research and educational content, not personalized investment advice. It's not a recommendation to buy, sell, or hold any security. Past forensic readings do not guarantee future outcomes. Full disclosures at insightfulagents.ai/disclosures/index.html. Link is in the description.